I think that right now I'm looking, first it's got to obviously test 1800 again, 1830. I believe there's resistance in that area. I believe that there's support right now at around 1734.
Gary, the gold price has been flat all year. I don't have to remind you or the viewers who follow the gold market very clearly. Do you think this Jackson Hole meeting is going to significantly impact the gold price in either direction, do you think?
It easily could. And I do have to take contention with saying that gold has been flat throughout the year, because when I look at a chart, I don't see it that way. I see a major rise up until March when it goes to $2,077. It's the high of the year. And then March happens to be the point in time when the Fed implemented its first rate hike. And as they implemented more rate hikes, gold went down further and further till it hit a bottom. And I believe that bottom was in place at $1,680.
Yeah.
Technically,
right. I should have specified. Yeah, it's flat year to date. We're slightly down, but you're right. It did at one point go above $2,000, and then it came very briefly, very dramatically back down. But yeah, please continue.
So my personal take is that once it hit 1680, the market was extremely oversold. I think that there was genuine interest that came back into the market, and that's what has bid gold prices higher. I think that right now I'm looking, first it's got to obviously test 1800 again, 1830. I believe there's resistance in that area. I believe that there's support right now at around 1734. But the key to what we witness in gold more than anything has got to be the dollar, because that's the one part of the equation we haven't really addressed yet. The dollar hit a 20-year high. And when it goes, the dollar index went to 109. When you look at it on a really long-term chart, a 2-month chart, you can see the last time that the dollar index was at 109 was moving up to 120. That happened in 2000, and moving from 120 way down to 73, and that was in 2003. So 109 is in a technical area where there really hasn't been any kind of historical top or bottom there. So if it continues to get strong, it's going to continue to weigh upon the price of gold. And that's been the number one adversary of gold moving higher, faster. If the dollar actually begins to subside its tremendous growth spurt that it's had, we have a real opportunity to see gold go a lot higher than just $1,800.
There's a view that if the stock markets move dramatically in either direction, that could impact the price of gold. If you assume that gold is somewhat of a hedge against volatility in the risk asset space, possibly if Jerome Powell were to make a statement that is more hawkish than anticipated, that could really dramatically move down the stock markets. Potentially, we could see a gold surge. Is that true, Gary? Do you think that could happen?
That's very possible. The one thing that I've noticed recently that is a fairly recent occurrence is we used to have that negative correlation between U.S. equities and gold. Gold did well. The stock market was going down. It was safe haven play or risk on play. What we've seen over the last year, because of the increased volatility, is when the stock market would go into a deep correction, gold would follow with it and go in the same direction down. Many people thought it was because it was just mass liquidation of assets to cover margin calls to get back into cash. But I think that if we see Powell's tone be extremely hawkish, I think that it would have a dramatic impact, a negative impact on U.S. equities, and it could also have a negative impact on gold at the same time.
All right, so what's your base case scenario for gold in the next couple of months based on the charts, based on the technicals?
Depending on the hawkish or dovish change in tone that we hear from the Jackson Hole Symposium, I think if gold continues to rise, we could break back above 1800, 1830. The brass ring is 1880. We have a major top there. If we have a tremendously hawkish stance, by that I mean they start announcing that, well, full basis point rate hikes are not out of the question, and we'll have multiple rate hikes of a percentage over the next couple of FOMC meetings. That's going to be a different story, because what happens then is yields go up, it makes the dollar go up because it attracts, the dollar becomes a safe haven asset rather than gold. So if you get an extremely hawkish tone where they're talking about accelerated sizes of the rate hikes, that could be an issue for gold. The play will be in yielding assets such as treasuries, notes, and bonds. And that, of course, will boost the dollar. It's going to be about the dollar, and the dollar is going to be based upon how hawkish or dovish the Federal Reserve is perceived to be once Fed members are interviewed this week, and, of course, the keynote speech by Chairman Powell.
This did put the Fed in an even tighter spot than they were already in, because think about it, yes, supply chain problems coming out of Eastern Europe may have exacerbated inflationary pressures, but had the Federal Reserve raised interest rates even more, or had they been starting to raise interest rates before that and then hiked it up even more following the invasion of Ukraine, they could have slowed the global economy down even more, right? So maybe at the time they were wondering to themselves, what do we do? Do we just let it stew for a bit, see what happens? Or do we do something now, risk slowing down the global economy even more, but possibly control inflation? Maybe that's what they were thinking.
If you listen to some of Chairman Powell's statements over the last couple of months, he's acknowledged that they should have acted sooner. And that's his words. How much would have it changed the overall picture? No one knows. But what we can say is the fact that there were new issues thrown into the mix. And besides the war in Ukraine, we had the lockdown in China. So we had an exacerbated supply chain issues because of that. They shut down cities at one point. So these are things that no one could have seen coming. And so you can't argue that the Fed didn't act quickly enough over those instances because no one saw those coming. But I really do believe had they started to use their toolbox much sooner, we wouldn't be looking at inflation sitting at 8.5% today. It might only be 6%. It might not be. I don't think he would have taken it to 4 or even the target level of 2 to 3. But yeah.